It now gives me great pleasure, and I'm very excited to introduce Anton Schutz and Natalie Friedman. These two are the co-presidents of our Stern Fintech Association, which is our Fintech MBA club. And so one of the most fun aspects of being at a university is getting to see the next generation of fintech leaders that are represented by folks like Anton and Natalie. And they're going to tell you a little bit about the Fintech Association at Stern, and they're going to introduce our two next speakers who are coming from the entrepreneurial side of DeFi, having started new businesses. So take it away, Anton and Natalie.
Thanks for the introduction, Kathleen. So before we hand it off to our next speakers, just wanted to give everyone a brief overview of the NYU Stern Fintech Association, also known as FTA. So FTA is a student-run organization consisting of full-time MBAs, Langone students and tech MBAs. We were founded in 2017, so not that long ago, one of the youngest professional clubs at Stern. We're also one of the fastest growing. We currently have over 400 active members within our club. Interest in the club has increased exponentially kind of with the expansion and relevance of fintech in the past few years. And we're also really well situated to continue to grow given the fact that we're the finance capital of the world in New York City. The fact that we operate in an institution that's extremely tech forward. NYU Stern is one of the first MBA programs to offer a fintech concentration. And we already have a robust set of classes relevant to students interested in the fintech space. I think we offered the first digital assets and currencies classes before they were cool and mainstream. So we also have resources within Stern that help in our growth, like the Fubon Center has been great. If you haven't already seen them, we produced a few knowledge bites, which are videos of different fintech topics, with the help of the Fubon Center. So if you're interested in seeing those, they're a really good way to digest kind of complex information. They're on YouTube or LinkedIn. And I'll hand it off to my co-president, Natalie, to talk about the club's mission and purpose.
All right. Thanks, Anton. So FTA's mission is to provide MBA students committed to careers in fintech with the resources to achieve their goals through career development workshops, experiential programs, speaking events, company treks, and networking opportunities. So we aim to provide a venue for corporations and startups to network with our members to enhance traditional recruiting efforts. Given the range of fintech verticals, we try to inform students about each separate fintech vertical. So we currently have 5 to 6 events planned for the spring semester that will cover 5 different key areas of fintech where our students have the most interest. So we're really excited about that. It's been an awesome journey working with Professor DeRose and the Fubon Center this past year, and we're so excited to be here. Great. So thank you again for having us. I think now we're going to turn to our next speaker. So I'm very excited to introduce Ben, who has more than 14 years of experience in quantitative finance in both the sell side and buy side. Before founding Algotune, he was the co-founder and chief research officer at a fintech startup called YieldX. And previously, Ben was a portfolio manager and head of risk premia research for Franklin Templeton Multi-Asset Solutions, managing macrosystematic, apologies. He founded Algotune to provide safe and attractive yield to fixed income investors who are struggling in their search for yields using traditional asset classes. So with that, I will go ahead and turn it over to Ben.
Absolutely. Thank you for that intro, Natalie. And I want to thank Professor DeRose and the team for organizing such an amazing event. There's so many topics that were covered today that are essential to our business models. And I'm going to talk a little bit about what we're working on at Algotune. So let me share my slides real quick. So essentially, we're a digital asset investment platform that leverages both CFI and DeFi to create a very innovative strategies for investors. For example, creating a fixed income replacement type of instruments. Essentially, the problem we're trying to solve is that investor needs higher yield without taking on sort of more risk. We're currently in a persistently low yield environment, and about 95% of all fixed income assets traded in the United States that's yielding less than 4% in nominal terms. So in terms of size, that's about $45 to $50 trillion worth of fixed income assets just in the United States that are yield very low yields. And investors are usually expose themselves to higher credit risk and higher interest rate risk. And but one of the reasons for that is because they actually need the assets to cover some of the liabilities, right? For example, if you're a pension fund and you have a defined benefit type of liabilities, you need the asset to generate enough yield, to cover that funding status. Or if you're an insurer, you have a universal guarantee income type of plans, you also need the asset to generate yield, sort of to cover that obligations. And that's why they're taking on more credit risk, more interest rate risk, just to chase after yields. I'm so glad that many of the discussion today talked about how yields are generated in the crypto asset class. So essentially, there for us, we conduct in-depth research on how yields are generated in the crypto space, and essentially there are 4 ways in our mind that yields can be generated. Right. First is like what Professor Khan was talking about. You can, mine or stake in the protocol by securing the blockchain networks, and in return you receive some sort of staking rewards. Right. Second is you can provide liquidity to decentralized exchanges, usually collecting about 0.3% of all the transaction volumes that happen on the decentralized exchanges. And this is very similar to like exchange rebates, and you can generate yield that way. Third is you can do collateral lending type of platforms. Essentially, this is very akin to if I want to borrow, if I want to borrow $100, I have to over collateralize and deposit $400, $300, or $400 worth of Bitcoin or Ethereums, and then the platform itself, the platform then lends out that $300 or $400 worth of crypto that I deposited to either short sellers or whoever needs that liquidity. And then the yield generated then gets paid out to the lenders within the platform that provided the $100 worth of whether it's a stable coin or other cryptos to start with. Right. Last but not least, you can also, take advantage of option premiums. You can do a cover call type of strategy. And the reason you can get pretty attractive yield is because the implied vols on these on the options in the crypto space are usually much higher than the realized volatilities, right? But the problem with all these type of strategies is that you're exposed to a lot of risk, sometimes not disclosed properly or not very well understood by the investors, right? And that's why our focus is to identify these type of risks and try to eliminate or mitigate some of this risk using our proprietary technologies. Let's talk about what's the first sort of scenarios we can use our hedge engine for. Number one scenario is for someone to provide staking, or someone's running a validator for a proof of stake type of consensus mechanism. So there's many examples of this out there, whether it's Ethereum 2.0, which is being launched late in 2020, or the Cardano's, Polkadot. These are all using a proof of stake consensus. You can generate pretty attractive yield by running a validator, right? Whether it's, I think Professor Khan's number was from 8% to 14%. But the biggest problem is that yield is in the underlying crypto terms, right? So even if you can generate 10% from these crypto from running the validators, if the price of Ethereum goes down, let's say 20%, you're looking at least a 12% losses on your portfolios. So what we do to hedge that price risk is very similar to a FX hedging for US dollar investors, right? If you're a dollar investor, you bought a Japanese yen corporate bond because you really like the company and the yield is very attractive. Usually what you do to hedge the dollar yen risk is by shorting some sort of FX forwards, right? Or if you're lazy, you just wait till the yen balance goes up and do a cash sweep and convert to a dollar. So we're essentially doing that in the crypto space in real time. Real time check your account balances, real time checking your hedge positions, and taking into account of transaction costs, taking into account of slippage. Make sure that we can generate and execute the order for you, so you can get to a target hedge ratio. And if that target hedge ratio is 100%, then we can generate up 6% of what we call the pseudo risk-free yield, and that is in fact currency terms instead of crypto terms. An investor will have zero exposure to the underlying crypto, and almost no credit risk. And at the same time, that's 10% higher than sort of your high yield saving accounts, and 2-3 times higher than your corporate bond yields. Right. So another way we can leverage our technology is in the liquidity providing space for DEX. Like what many of the professor practitioner already talked about. What you can do is you can provide liquidity to these decentralized exchanges in the yield pool, and based on the transactions that are happening based on that yield pool, you can get about 0.03% of all transaction volume that happens, right? But the problem is there's still quite a bit of downside risk, especially from a dollar investor perspective. So this is the screenshot I took from SushiSwap, is one of the DEX out there. It states that you can generate about 18.5% yields by providing liquidity to that liquidity pool, right? Never mind sort of the platform token issues that many others already talked about. Let's assume that you can get 18.5%, right? But the problem is, let's say within 30 days, if your Ethereum price drops 15%, right, you're going to have your price loss. You're going to have impermanent loss, which actually grows exponentially as the price varies from the point when you deposit liquidity. And in total, you're looking at least 6.3% of overall portfolio P&Ls, right? Portfolio losses. And for a fixed income investor, that's a big no-no. They would not feel comfortable losing 6% of their principals just within 30 days, especially for fixed income investors, right? So then what we do is that the hedge engine can actually do delta hedge, right? The hedge engine can calculate the deltas, very similar to like a derivative portfolios. If you work on a derivative, a sell side desk or option desk, you know exactly what I'm talking about. The hedge engine will calculate sort of the deltas and automatically generate the sort of the delta neutral trades and execute them in real time. And in turn, we can convert that 18.5% to a fiat currency based yield. This can generate much higher return profiles, but then there's additional risk you have to put into consideration, because now you're involving smart contracts. You have some credit risk with the decentralized exchanges and etc. And this is essentially the primer of how the hedge engine works, right? We're essentially bringing in the CFI and DeFi together. Essentially, the hedge engine gets data directly from on-chain, right? Whether if it's your up-to-date balance of your staking operations or your hedging positions, and then based on your T cost, based on slippage, based on your target hedge ratio, the hedge engine in real time figure out what the optimal order is for you to execute. And then the order gets created, routed to a centralized exchange or a decentralized exchange, right? And then the order gets executed. And then you will see, as an investor, you will see the real-time positions and real-time trades that are happening within the portfolio. Now, this sounds fairly easy, but in the background, it's actually fairly complicated, because we have to worry about margins on the hedging side of things, right? If your hedging position is losing a lot of money, you could potentially get a margin call on your hedging accounts, and therefore the hedge engine needs to be smart enough to be able to transfer the assets from your yield generating component back to your hedging components, and vice versa. Because if your hedging account is making a lot of money, you have excess margin or excess cash sitting in your hedging account doing nothing, then the hedge engine is smart enough to convert or transfer that excess cash from hedging side back to the yield generating side. So that's essentially how we're structure the hedge engine. And in terms of revenue model, we have two revenue streams in terms of revenue model. One is we are asset managers, right? So we provide investment product to investors, and in return, we're charging AUM fees on top of it. At the same time, we are actually, everything you see in the hedge engine is exposed through a web service API. So then, we can, there's usage of this web service API. For example, for a, staking operators or a miner, what they can do is, they want to use the API to hedge their downside risk. They can easily do that with minimal setup. And also for asset managers who wants to have a sort of crypto portfolio or crypto product for their clients, but if they don't have the expertise for it, then we can white label a product using our hedge engines and just charge them for API usage fees. So that's sort of the high level overview of what we're trying to do. The product is about to launch end of Q2 this year. And obviously, we'll love to stay in touch with everybody here. And we're publishing a whole bunch of articles on medium.com as well. So love to hear feedbacks and get more involved.
Thank you very much, Ben, for that overview of Algotune. So I'm happy to introduce our next speaker, Jonathan Grady. Jonathan is a Stern MBA and the founding principal of the Canary Group. Put simply, Jonathan forecasts negotiations. He can forecast negotiation outcomes, their process, and how the stakeholders will negotiate. Jonathan can advise how to shape negotiations for more winning outcomes. He recently put together a major forecast project for CNBC on China using inputs from world-leading experts. That project recently further progressed into a CNBC internationally televised feature documentary for its unexpected and surprisingly accurate predictions. It is the highest performing negotiation forecasting service and can advise business negotiations from deal-making to strategy. Welcome, Jonathan. The floor is yours.
Thank you very much, Anton. It's really very much a pleasure to be here and very much humbling to be with such a great group of people. And thank you very much to the NYU Stern Fubon Center for putting together such a great event. Professor DeRose, Liz Chen, and everybody else. Really amazing work that you've done already today. I'm going to talk today about China's emerging digital currency. Specifically, I'm going to talk about the considerations that fintech experts, analysts, and investors are going to have to keep in mind with regard to the new digital currency. It's a very particular digital currency because there is a large driving political influence behind the digital currency's rollout, and being mindful of this political influence will be critical in understanding the role the digital currency is playing for China. So, quick little summary of what I'm going to say. As I said, there is a link between Chinese politics and China's emerging digital currency. The e-CNY, otherwise known as a Chinese digital currency, is now being deployed across China with an already significant number of downloads. Already 1/5 of China's population has downloaded e-CNY. There are, however, challenges to adoption, but there is strong government support. e-CNY is likely to offer a range of economic benefits, which I will discuss as an overview. But at the same time, there are concerns about its use both domestic and abroad. It can be used as a tool to evade U.S. financial sanctions since the e-CNY routes outside of the existing SWIFT network. It can also supplement China's surveillance system against regime challengers and dissidents for financial surveillance and asset freeze uses. And finally, from the CNBC Forecast Project, where we found factionalized Chinese elite politics and a growing evidence of increasingly tense Chinese factions, the e-CNY may well provide a useful tool for the PRC against regime challengers and dissidents. So I'm going to discuss what is the e-CNY, its overall structure, its benefits, its drawbacks, provide an understanding of where some leading experts see e-CNY moving, and then talk about larger implications for China from what we have established from CNBC and established reporting thereafter. So what is the e-CNY? Well, it's a central bank digital currency. It's a digital version of the RMB issued by this Chinese central bank. It's very important to know that this is not a cryptocurrency with a decentralized settlement. This is a state-backed currency. So therefore, since it's part of the currency, the e-CNY is a form of money. It can be used as a medium of exchange, a unit of account, and a store of value. And currently at where it stands, it's in an early rollout stage across a number of cities. And as I said, already 1/5 of China's population have downloaded e-CNY wallets. The challenge for China is to get people to use the e-CNY in terms of volume, but we see the Chinese government has already been pushing for e-CNY adoption. Major Chinese apps already offering e-CNY as payment include Alipay, WeChat Pay, and Meituan. Meituan is a large food delivery service that dwarfs Uber Eats. We also see the Chinese government pushing e-CNY adoption in a large range of different other places, including McDonald's. So let's talk about the overall structure of the e-CNY. It's spoken about in terms of one coin, two databases, three centers. Well, one coin obviously is the unit of currency. We want to look at the two databases and three centers. There's an overall tracking system from the Chinese central bank to monitor outstanding e-CNY. That's one database. Another database will monitor all e-CNY ledgers that will be on the local level or used by the same cloud system as the Chinese central bank. Importantly, we want to look at the centers that are operating behind the e-CNY's rollout and use. There's a certification center. There will be a database of real identities tied to digital wallet holders. So your identity will be known when you are using e-CNY. The government will know who you are. There's a registration center. It will track e-CNY ownership and transaction history. And finally, there is an analysis center. Some people have called it the big data center. It will monitor payment flows for financial risks and illegal behaviors. Importantly, the CCDI is a leading stakeholder in the rollout of the digital currency. The CCDI is the Central Commission for Disciplinary Inspection. Their main role now is tasked with finding corruption, investigating corruption, charging individuals for corruption. Ultimately, this is an organization that plays a large role in purging political challengers of the current Chinese Central Party. Now that we know where the Chinese digital currency is and the sort of structure behind it, let's talk about its benefits. The direct interface between the central bank and user allows a more streamlined transaction process compared to traditional bank processing. Users can interact directly with the central bank instead of the convoluted process of banks communicating with each other. Interestingly, the e-CNY is designed to handle at least 300,000 transactions per second, which is dramatically higher than the Alipay ceiling of roughly around 250,000 transactions per second. The e-CNY is being designed to be a major factor, a major major tool for the Chinese economy for transactions. Interestingly as well, transactions can be done while using fractions of existing currency. While we're hobbled when we exchange currency with each other in terms of coins and whatnot, that will not be an issue with the e-CNY. We can use fractions of cents when transacting with e-CNY. Because so much data is offered, collected as a result of the extensive database and centers, there is a substantial amount of economic data that can be collected about the Chinese economy and analyzed in real time. That offers a lot of different insights about the Chinese economy. There's also, interestingly enough, a certain level of anonymity about the e-CNY, even though there is the knowledge of individuals and their transaction history by the central bank. Specifically, there's an anonymity in transactions between users. Controlled anonymity has been one of the phrases used to describe this. So transactions between you or me, between a business and another individual, a consumer, a customer, that will be largely anonymous, but there will be a cloud over the top of these transactions from the Chinese central bank, which will monitor and know the transactions. interestingly as well, transactions can occur without internet access. So the Chinese central bank has discussed a motivation for the use of the e-CNY. It has discussed the e-CNY will replace cash in China. So we see the steps already being made, the offline uses and the large expansive capacity, that it can be a substitute to cash. I call this a digital currency with Chinese characteristics when looking at the potential drawbacks of the e-CNY. The e-CNY, as I mentioned, routes through the SWIFT banking system, which the US uses for financial sanctions. e-CNY, as a result, has the potential to erode some US ability to enact financial sanctions since it goes outside of said SWIFT system. This can then therefore help avoid US financial sanctions against both Chinese individuals and entities, but interestingly as well, outside individuals or entities that do business with China. So there's an open question about the extent that this new emerging digital currency can erode the potential for US sanctions, both in China and abroad from China. It can also supplement state surveillance. It offers the ability to monitor individual transactions and even freeze e-CNY digital wallets. As I mentioned previously, the CCDI is a major player in the development of the e-CNY. It already has a team in the central bank to investigate graft. This organization is playing a leading role in the development of the e-CNY, and something that people need to be mindful of when looking at this new emerging digital currency. The CCDI has already explained in an article, e-CNY can be used for investigations, specifically funds tracking of specific individuals and transactions of interest. This offers the government an expansive new tool to monitor and sanction potential government challengers and dissidents. As you can see here, there's a picture of the CCDI meeting. I did an interesting temperature check of where leading experts in the fintech space see e-CNY adoption. I surveyed 16 experts around November, and I asked them for a number of different time periods where they see e-CNY being adopted as a proportion of RMB in terms of transactions. I used 3 dates. I said, I used the end of the Beijing Olympics, March 1st, 2022. I used the end of this year, 2022. And then I used a politically important date for China, the 75th anniversary of the PRC, which would be October 2024. And the results that we got were fairly interesting. The experts who span leading business school professors, investors, analysts, policymakers, even individuals who are part of this conference, they see the e-CNY developing into a consideration moving forward into the future. The open question is, to what extent does the e-CNY develop? How far does it develop in its growth? Some people think it will be a minor consideration. Others think it can be a major consideration. Seeing where the Chinese government is pushing it forward is a major consideration as well. That was a discussion, comment often made by the different experts that depending on how far the Chinese government wishes to push the e-CNY forward will ultimately determine the extent of its adoption. And there's a number of different ways China can do that, whether through the social credit system, government services, or whatnot. So there's an open question of how far e-CNY can gain market share in the overall transaction payment space. So knowing this information, I would like to connect it with the CNBC Quad project. The CNBC Quad project was an ambitious project from a few months ago, where the question was to forecast the extent of multilateral coordination with regard to maritime security in the larger Indo-Pacific region. The Quad is the US, Japan, Australia, and India. It's an informal maritime coalition, military coalition in the larger Indo-Pacific region. I generated a data set of roughly 300 stakeholders across 15 countries. That included the 4 countries mentioned, China plus 10 countries that had a stake in the Indo-Pacific. The model used for that project is over 90% accurate per a declassified CIA report. The author of that declassified report would later state that the agency used this model over 1,200 times in over 75 countries across a range of issues, and was consistent with the declassified report. The model has previously been in the Wall Street Journal forecasting the Comcast-NBC deal, that it would happen, the surprising dollar amount, and how the different stakeholders would negotiate. In the model's 40-year history, this was the most complex and sophisticated use of the model, from use cases ranging from the CIA to corporate clients. I used inputs from leading world experts. So I want to focus now on the findings from this project as it relates to e-CNY in China. So specifically, we included an analysis of the Chinese government from the perspective of the Quad's decision-making. I took a very deep dive into the Chinese government. I analyzed a number of different governing bodies, including the Standing Committee, the State Council, the Central Military Commission, the Foreign Affairs Committee, various party secretaries, SOEs, members of the larger foreign policy apparatus, and other unique interested parties. The forecast ultimately offered unexpected and surprisingly accurate insights for domestic Chinese politics. At the time, we found deep and very tense factionalized politics across senior military, foreign policy, and government figures in China. Interestingly, this was at odds with the consensus view of leading experts at the time. There was a belief that Xi had adopted so much influence and authority that no one could defy him. But from the model's results, it's indicated that for the next couple of years, there's going to be a significant amount of factionalization happening in China. Interestingly enough, the events on the ground since then have aligned with reports from the CNBC Quad project. And outside of that project, it even accurately predicted the unexpected moves by Vladimir Putin. We were able to forecast that the Russian government over time would acknowledge and favor the 9-dash line policy has to be renegotiated, that there would be an acknowledgement of need for negotiations over the competing resource-rich maritime claims. That was something that a number of experts were unsure about, but very interested in. Less than 3 weeks later, Vladimir Putin gave an interview to CNBC acknowledging the need for negotiations over the 9-dash line policy. And interestingly enough, that China, quote, does not need to use force on Taiwan. The model also interestingly indicated that Russia would drop its focus on the Quad and maritime security, which was a very surprising result. It aligns with events now with Ukraine. While the events in Ukraine are surprising, they're not unexpected. There were only a number of things that could have filled the vacuum for Vladimir Putin's interest in focus if the Quad's focus was dropping for him. So it's already been a highly outperforming model that outperformed the consensus view of a number of really fantastic world-leading experts. I'm going to talk a little bit deeper about this from what we're seeing now. There's been a steady drumbeat of reports of increasingly tense factionalized politics following the report. The Fubon Development Institute at Fubon University wrote about my work, and they called it Professional Predictions in Chinese. Nikkei has followed China's factions frequently. There's reports of China's party publications openly bickering over the different political factions. A leading Hong Kong journalist has spoken about the increasing factions in China. She is seeking support from the military, consistent with what we found with the factionalization across the government. And really interestingly, George Soros has even chimed in. He spoke recently saying that internal divisions in China are so sharp that it has found expression in various party publications, that she is even under attack from those who are inspired by Deng Xiaoping's ideas and want to see a greater role for private enterprise. The situation in China is becoming increasingly tense. So the way to look at e-CNY as we connect it to what we know from the forecasts and established evidence is that Xi Jinping is facing an increasingly tense and factionalized political situation. While he has consolidated power in the past, he's also faced threats. He survived a major coup attempt from several years ago. This was documented from a New York Times article which discussed Xi himself talking about talks of plots against him. So what we know from factions, the e-CNY has the potential to play a significant role as a digital currency with Chinese characteristics for Chinese state security, for pushback against regime challengers. It offers expanded financial surveillance and asset freeze uses against these challengers and dissidents. And being mindful that the CCDI is a leading figure in the e-CNY development and has spoken already at length about the use of e-CNY to investigate, monitor, and charge people with illegal activities is all the evidence that we need about the unique political situation considerations that are happening with the e-CNY's rollout. So in conclusion, the e-CNY is a new and growing Chinese central bank digital currency with lots of potential, and it can offer a lot of benefits to the Chinese economy. But we must be mindful that this is a Chinese digital currency with Chinese characteristics. There are political considerations that we must know as fintech experts, analysts, and investors. There is strong suggestion that there are political motivations to the e-CNY rollout as being part of the Chinese surveillance state. And finally, given the rollout of e-CNY, this is something that should be on everyone's radar, but we should also be mindful of the unique place that this digital currency has for one of the world's largest economies. Thank you.
Thank you, Fintech Association, for those great introductions and an introduction to our MBA Fintech Club. And thank you to Ben and to Jonathan for two really incredibly interesting applications of what's going on in DeFi, both applications in business and also applications in geopolitics. And this gives us the chance to broaden out and pick up on many of the themes that we've heard throughout the day today.